You look at your bank account and see a number that remains stable, but beneath the surface, your wealth is silently leaking away. This is the concept of hidden friction. Inflation and banking fees work together like an invisible drain, constantly eroding your purchasing power. While your balance may appear unchanged, the real value of your money is decreasing every single day. Understanding this invisible drain is the first step to reclaiming control over your financial future. Banks invest heavily in marketing themselves as the ultimate guardians of your hard-earned capital. They build an image of ironclad security. But look closer at the reality. While your nominal balance might stay static, the silent tax of inflation is working against you every single hour. Every hour, your money sits stagnant in a standard savings account. It loses purchasing power. You are not protecting your wealth. You are watching it evaporate. True security requires growth that outpaces the decline. Anything less is simply the illusion of safety. Most people look at the balance in their bank app and feel secure. The number stays the same. But that number is a mirage. This is the inflation tax, a silent, invisible thief that erodes your wealth while you sleep. While your account balance sits perfectly still, the cost of goods and services rises. As inflation climbs, the actual goods your money can buy shrinks dramatically. Your money isn't just sitting there, it's losing its strength every single day. This is the tax you pay for doing nothing. The business model of a bank relies on a silent, calculated gap. They take your deposits and lend them out, pocketing the difference between what they pay you and what they earn from borrowers. Consider the gap. On the left, a tiny percentage returned to you. On the right, a significant return generated from your own capital. This margin, known as the net interest spread, is how they profit. They aren't just holding your money, they are effectively living off the margin of your capital. In essence, your capital becomes the engine of their institutional growth, while you receive only a fraction of the value created. Most people view compound interest as a tool for wealth creation, but in the hands of a banking institution, it becomes a silent drain on your financial future. Your money is pooled with millions of others. The bank doesn't let it sit idle. It is immediately deployed into high-yield loans, mortgages, and credit instruments. While they pay you a fraction of a percent, they multiply that value through the massive scale of compounding interest on the debt they create. They keep the lion's share of the generated wealth. Mathematically, the time horizon for their compounding is infinite, while yours is limited by the tiny static rates offered to your account. You aren't just saving, you're fueling their growth. What appears as a minor inconvenience today becomes a massive loss over a lifetime. Financial institutions often trap your savings in a complex web of small, automated fees. Maintenance, overdraft penalties, wire transfers, and inactivity charges act as silent traps. These small deductions, repeated over time, drain your capital without you noticing. Many financial institutions impose a minimum balance requirement. When your balance sits comfortably above the threshold, the account remains dormant and fee-free. But should your balance dip just a fraction below this arbitrary line, the trap is triggered. The institution automatically deducts a monthly maintenance fee. This is a tax on poverty, shrinking your remaining balance even further. It is a system built to prioritize institutional profitability over individual financial accessibility. The float represents the silent gap in our financial system. It is the time delay between you initiating a transfer and the funds actually settling in the recipient's account. During this period, your capital is technically in limbo. It has left your possession, but it hasn't reached the destination. While you wait, the bank holds your liquidity. They don't just keep it idle, they utilize these billions of dollars to earn interest, effectively capturing the value of that time gap for themselves. By the time the money finally clears, the institution has already harvested the hidden profit from your float. It is a subtle, institutional capture of liquidity that remains invisible to the average user. Banks sometimes employ a strategy called overdraft engineering. They don't process your transactions in the order you made them. Instead, they reorder them to maximize your fees. By processing your largest transaction first, they drain your account balance instantly. This ensures that every subsequent purchase triggers an expensive overdraft fee. What should have been a minor oversight becomes a cascade of financial penalties, a calculated strategy to profit from your human error. You are simply trying to access your own money, but a hidden system stands in your way, treating your bank balance as a profit center. Every withdrawal triggers a toll. First, the ATM owner demands a fee for the machine's usage. But that is not all. Your own bank then charges a network fee for out-of-network access. This is double dipping. You pay twice for the same simple action. Simple access turned into a silent drain on your financial resources. The real theft of your wealth often hides in plain sight, buried beneath thousands of words of dense, impenetrable legal jargon. These contracts are designed not to inform you, but to obscure the terms of your own financial surrender, making you accept hidden losses as standard. Buried in these pages lie the mechanisms for draining your balance. Service fees, maintenance costs, and withdrawal penalties, all hidden in the fine print. You aren't just signing an agreement, you are consenting to the erosion of your capital. Most people focus on the nominal interest rate promised by their bank, but that number is an illusion if it doesn't account for the silent thief, inflation. To find your true return, you must calculate the real interest rate. This is simply the nominal rate minus the rate of inflation. When inflation outpaces your interest, the result is a negative real rate. Your wealth is literally shrinking while it sits in the account. In this environment, holding cash is a guaranteed loss in purchasing power over time. Millions of accounts lie dormant, scattered across the financial landscape like digital dust. When an account is forgotten, the money doesn't just sit there. It becomes a source of capital for the institution. While the original balance remains untouched, the interest generated by these funds is often captured by the bank, creating a silent pool of revenue. This digital dust fuels a cycle of profit that the original owner can no longer reach, effectively leaving capital trapped in the void. Banks no longer just take your cash, they profit by harvesting your digital life. Every purchase, location check, and payment is a data point. They transform your personal habits into actionable insights, selling them for profit. This extraction is a hidden form of value loss, converting your identity into their currency. Most depositors believe their funds sit securely in a vault. In reality, your money is often used as collateral to secure the bank's own leverage, fueling its expansion and risk-taking. This creates a dangerous hierarchy. If insolvency strikes, the institution prioritizes its own survival, using these assets to satisfy higher-level creditors, long before you regain immediate access to your capital. Credit cards are often presented as a convenience, but beneath the surface lies a mechanism designed for profit. It is a tool that turns your future earnings into the bank's current income. When you carry a balance, you aren't just paying for what you bought. You are paying a premium to access your own future money early. Banks capture your future productivity as their present revenue stream. By engineering models that prioritize interest revenue, they ensure that the cost of your purchases compounds over time. This makes the trap difficult to escape. Most consumers see their bank as a safe, static vault, but behind the scenes, your deposits enter a complex black box. Once deposited, your funds are immediately moved, leveraged, and hedged by the bank's investment arms. These paths are rarely visible to you. They are funneled into leveraged loans or complex financial hedges, effectively shielding the bank's operations from your view. This lack of transparency keeps the true inner workings of your money entirely hidden from the customer. If you leave your wealth idle in a standard bank account, it is not merely sitting still, it is actively shrinking. Inflation and hidden fees act as a constant, silent drain on your capital. Over years, this creates a massive transfer of wealth from your pocket to the institution's bottom line. The cost of doing nothing is far higher than the risk of moving your money into more efficient assets. Every day you wait, you are losing potential value. It is time to shift your perspective. Banks offer convenience for your daily life, but they are not the engine for building long-term wealth. Transition from a state of passive fear to active awareness. Your knowledge is the ultimate defensive tool in a complex financial landscape. Financial literacy is no longer an option. it is your primary defense. By mastering the mechanics of how money works, you reclaim control over your own future. The bank account is for your immediate survival. Keep only your essential liquidity needs here. Beyond that, stagnant cash is a liability. Excess cash belongs in assets that can beat inflation. This is where wealth is built, outside the confines of a standard savings account. Allocate your capital wisely. Liquidity for safety, assets for growth. Take control of where your money lives. To protect your hard-earned purchasing power from erosion, you must look beyond traditional, stagnant storage methods. High-yield savings accounts provide a crucial buffer, offering interest rates that attempt to outpace inflation. Treasury bills offer a government-backed alternative, serving as a pillar of security in an uncertain financial landscape. Finally, diversified investments allow your capital to participate in market growth, transforming mere digits into protected long-term assets. By shifting your strategy, you move from passive loss to active wealth protection. You have the power to stop the bleed. Begin by conducting a forensic audit of your financial statements. Look for the hidden costs you've been conditioned to ignore. Demand better. Institutions rely on your complacency. Contact your bank, question every fee, and demand lower rates. If they value your business, they will compete for it. Finally, be prepared to move. Wealth building is not a passive act. Transition your capital to institutions that align with your long-term goals, not their short-term profits.